Let me ask you your big picture view then. You've
Sure.
been cautious in the last few months.
Yeah.
We've seen a deceleration in some of the leading indicators for the global economy, haven't we? Manufacturing, PMI certainly amongst them. But how much of that is already priced into markets, do you think? Or how much do we go down from here?
I think a fair bit's been priced into fixed income for certain. And I think on a forward-looking basis for the remainder of this year, probably will be very difficult for fixed income to outperform even further than what it has done in recent months, particularly in August. But what I'm not confident on is that we've seen the inflection point yet that would make me more confident that you could see a pronounced sell-off in fixed income and have the underperformance come from that side of the market. Simply because if you look at trade figures and growth figures in East Asian trade and industrial production, this morning's Swedish PMI indicator, as tiny of a country as it is relative to the global economy, it actually says quite a lot about the manufacturing cycle because it does lead data in Europe. And it points to the notion that the broader European economy is still going to be subject to some pressures due to natural slowing after its strong growth a couple of years ago, but also related to fallout from trade disputes.
Swedish PMI, I'm going to put it on my dashboard, Tim.
Yep.
Okay, Matt.
So before we get to the issues that the European economy faces, I want to jump on something else you touched on there in terms of yields, Tim. One of the interesting side effects of the repo issues that we had over the last couple of weeks is that it really put the possibility of new QE into focus. And even if the Fed doesn't call it that, as the central bank has to take the proceeds from all of the mortgage bonds they hold that are maturing, they're going to have to boost their balance sheet in a big way with Treasury purchases. Don't you think that is going to help put a bid under Treasuries?
It depends. I mean, some of this can be done in a fashion that's not potentially permanent. So if you set up, say, a standing repo facility as a first gauge towards assuaging some of these concerns we've had around funding at quarter end and potentially coming up at year end, that might help. There is the potential for there to be a reserve buffer created using more permanent operations. And I suppose that might help from the perspective that it will, A, lower yields, it might weaken the dollar. But I do wonder if this is now discussed enough that it's becoming consensus that they have to do this. Banks are now talking about anywhere from $200 to $300 billion in purchases to come on a permanent basis to build sort of a reserve buffer. I wonder if that's starting to be discounted in the price. It almost, and the notion that the Fed is going to organically grow its balance sheet is something the Fed has told you they're likely to do. So I don't know if it's going to be enough to move the dial substantially, other than maybe getting rid of these quarter and year-end implications for funding markets that have worried us the last couple of weeks.